Hi, today's video is about the spread, but apart from digging down what it is, what influenced the size of it, I will talk about how to make money from spreads. So grab a cup of coffee or tea if you prefer, and let's start with the video. So what is a spread in forex trading? One of the most frequently asked questions on trading forums is what is a spread in forex? So let's try to find out. In modern life, we have to pay for goods and services, including those provided in the financial markets. The most popular and demanded service in trading is brokering. A brokerage company provides access to the international financial markets so that users can make transactions. So brokers charge a commission for their work, and it is called the spread. Next, we will talk about what is the spread trading. So to explain this concept, I should mention that the spread in forex trading often means the commission charged by the broker for conducting a buy or a sell trade for you. In global financial trading, the spread is defined as the difference between the buying and the selling prices of the same asset. If we mean the difference between the buying and the selling prices for the spread, it looks like this. If we understand the spread as a real difference in the prices for an asset or assets, it looks like this in this chart. These are two popular benchmarks, UK Brent and Western Texas Intermediate, namely their CFDs. Although it's basically the same black stuff, it has different prices. So historically, the Brent crude oil has been more expensive than the North American WTI, but the difference is very small and averages in the $3 to $5 range. However, history knows many cases when the usual range has changed. It even happened that WTI cost more than Brent. So the ratio of the prices of these assets is called the spread position. We can also come across the concepts of correlation or correlation factor. So, spread trading or a spread position is a method of trading that involves making profits from the changes in the difference between asset prices. How do traders make profits from spread? So, if you look at this example, you will see that sometimes spread narrows and sometimes widens. So, primary goal for investors is to use the spread itself as a way to generate profit when the spread widens or narrows. So, spreads are either bought or sold, depending on whether the trade will profit from the widening or narrowing of the spread. So first, narrowing of the spread position. So to make profits from a narrowing spread, you need to watch the periods when the difference in the quotes of two assets is greater than the average value. In general, the strategy of making money on spreads is one of the longest, as it requires preparation and works out more often in long-term timeframes. Some trades can take even about a year. So this strategy is the most conservative as there is almost no risk. Therefore, it is usually used by large financial institutions such as pension and insurance funds, and simply by large investors. Let's analyze this. First, we need to study how two assets have been moving relative to each other over a historical period. An ideal option would be to overlap two charts, but not all platforms provide such a possibility. So, after overlapping the charts, we need to determine the average price difference for these assets. In the case of oil charts, as I mentioned, the average price difference is from $3 to $5. So we should look for moments when this range is wider than $5. So in this chart, the most noticeable spread changes are marked on the left. The difference in prices reached even $10. The widening of the spread is up to $10 is a deviation from a median value. So it makes sense to bet on the narrowing spread, expecting that the difference will tend to the common range. Ideally, the position is formed on the expectation that a more expensive asset will depreciate and the cheaper one will appreciate, so that the difference in values will narrow. But such a situation is a rare case. Most commonly, two assets are moving in the same direction and the cheaper asset rises in price faster, thus narrowing the spread. To avoid risks, you could open a counter position. And it means we sell more expensive oil and buy the cheaper one. For example, there is a situation in the chart when Brent is $85.65 and WTI is $74.01 US. So the spread is more than $10. And we bet on the spread narrowing. We sell Brent and buy WTI. After a while, we see that oil starts depreciating, the Brent sell trade is winning, and the WTI buy trade is losing. So the strategy would seem to fail. However, sometime later, Brent is down to $50.21 and the WTI hits $46.78. So the Brent trade has yielded $34.44 of profit, and the WTI purchase caused a loss of $27.23 US. The total position has yielded a profit of $7.21 US. The profit could seem insignificant, but you need to take into account a lot of factors. First, the position is almost risk-free. Second, this is an example for one lot, so it is convenient to calculate. Now, imagine that financial institutions open such positions. They make huge profit with virtually no risk. By the way, this position is one of the ways that banks earn by using depositors' money. Now we will talk about a widening spread position. So, this position is opened while betting on the widening of the spread. You need to spot the moments when the difference in the asset values is the tightest and open a position expecting the spread to widen. So let's go back to the same chart. There is a situation when the prices for Brent and the WTI are almost equal, and there is an opportunity to make a profit from the spread widening. Here, we shall sell the cheaper asset and buy the more expensive one. Supposing Brent is $77.34 US and the WTI is $77.02 US. And after a while, both benchmarks grow in value, and the Brent purchase generates a profit of $34.23 US and the WTI sell yields a loss of $30.12. So the total position has made a profit of $4.11 US. As you see, the position bears almost no risk. I mentioned that most commonly the Brent is more expensive than the WTI, but if the opposite happens, the position will bring a loss. So in such a case, when the WTI price is higher than the Brent, remember that this is the maximum deviation from the average and it can be lasting for a long time. So simply in those situations, you just hold the position on if you are in a trade already, or just wait for this to pass if you're not in the market. So another friendly reminder is that you can trade the spreads using only closely correlated assets. For example, they can be the assets from the same sector, such as stocks of Apple and Microsoft, but I would be rather very cautious as for this one, or Euro USD or GBP USD in the case of currency pairs. So you should not trade a spread using assets from different sectors. The convergence in price doesn't mean the assets will be moving in the same direction. So now let's talk about spread examples. So Forex spread varies based on several factors. In this chart, in addition to the bid and ask columns, there is the third one that shows the spread size for each trading asset. You see, spreads are quite narrow for some instruments, about 20 to 40 pips. For other assets, the spread size could reach 200 or 300 pips. And there are several factors affecting the spread width. First of all, the spread is affected by the liquidity of the trading instrument. In simple terms, liquidity is the popularity of a trading instrument. The more trades conducted with an asset, the more liquid it is. This is a key parameter to calculate the spread size. High liquidity always correlates to a tight spread, and vice versa. Low liquidity corresponds to a wide spread. You can see from this table that the popular currency pairs are always traded at a narrow spread. This is the law of trading. The second important parameter is volatility. So the volatility also greatly affects the size of the spread. When volatility increases, the number of price fluctuation increases, which means that the spread will widen. When volatility declines and the price changes occur less often, the spread will narrow. Thus, the spread in the foreign exchange market is an indicator of volatility. Everyone knows examples when at the time of publication of important fundamental news, volatility increased sharply and the spread also increased. For example, the geopolitical tensions and the economic confrontation between the US and Russia resulted in a surge in financial markets volatility. The highest volatility was featured in the US dollar against the Russian ruble currency pair. In standard situations, the spread for this currency pair doesn't exceed 4,000 to 5,000 pips. But when the volatility surged, the spread reached 10 to 11,000 pips. And in some banks, the difference between the offer and the demand prices reached even more than 110,000 pips. And one more factor is the interest of the broker. So another part of the spread is the interest of the intermediary, that is a broker or dealer. The intermediary sets the broker spread. Each broker offers its own spread, but in the end they will be about the same because the share of the broker in the spread is not so high. Unpopular brokers set a higher spread, while popular ones, on the contrary, try to reduce it as much as possible in order to attract new customers. So that will be all for this video. Hope you like this one, learned something useful, and I'll see you in the next one. Bye bye.